Rajiv Anand, Deputy Managing Director of Axis Bank, is joining me now. And who better to tell you what this would mean for the banking sector and indeed for you? Rajiv, thanks as always for taking the time and for speaking to us on NDTV Profit. Some people were murmuring, yeah, our pleasure entirely. Some people were murmuring that there was a possibility of a repo rate cut. And when the RBI governor stated that there wouldn't be one, perhaps some people were a little bit disappointed. They were also talking about a CRR cut. And whenever I've been taught about monetary policy, Rajiv, you correct me if I'm wrong, the repo rate is looked at as a scalpel, whereas the CRR is looked at as a hammer. Correct me if I'm wrong, what the impact of this will be.
I think in an environment where inflation in India currently is running at 6.2%, although the trajectory is expected to tend towards 4 over a period of time, it was highly unlikely that the RBI would cut the repo rate at this point in time. But on the other side, we've all seen the shocker in terms of the growth number for Q2. And so therefore, there was some expectation, from certain quarters that to be able to support growth, the RBI would cut the repo rate. But I think, what the RBI has done is actually, quite prudent, that they have kept their eye on the ball, i.e. inflation. And the expectation is that sometime around February, we could see inflation becoming a little more manageable. And perhaps expectations of a rate cut sometime post-February is the expectations that the RBI has built in this policy. However, on the other side, we've also seen the short-term rates, i.e. the rates between the repo rate and let's say a one-year fixed deposit continues to be quite high. And what the CRR cut will actually do is that it'll bring that rate down, meaning that if you are a depositor, you should expect that deposit rates will come down in the months to come because of the fact that the CRR has been cut. So it's a liquidity measure. Short-term rates will come down because inflation still continues to be sticky in an environment of relatively weaker growth. I think the expectations of a repo rate cut have been pushed out by some time.
Okay. Rajiv, implications of this 1.16 lakh crore coming in to the banking system over the course of 2 fortnights starting the 14th of December, in the context of the measures that have been taken and the commentary that has come in over the last 2 quarters from the RBI itself about the kind of lending that banks and the financial institutions have been doing, of course, there is no mandate to say they will utilize these funds in a certain manner. But because some banks and institutions have been more wary in the unsecured space, where do you think this money will be utilized?
Let's look at it like this. The 1.15 lakh crores was earning the banks nothing because it was impounded as CRR. Now that it is being released, at the very least, we can actually go out and put this money in overnight liquidity at 6.5%. Obviously, what banks would do with this money is they would put this money into a mix of corporate lending, retail lending, including unsecured, and so therefore this CRR cut will positively impact NIMs of banks by somewhere between 3 to 5 basis points. Not in this quarter, but because the CRR is being released in 2 tranches in 2 fortnights, the impact will come from the next quarter onwards.
Okay, that's an interesting point that you make, and so therefore no immediate implication, Rajiv, you would think on the lending rates at all, or not lending rates, but lending growth at all in any segment on account of this?
Because of the macroprudential measures that the RBI has taken, I think RBI has consciously pushed the rate of credit growth down over the last, let's say, 6 to 9 months. I think we've also seen that, particularly on the unsecured side, risk has gone up, although from relatively lower levels. I think the CRR cut is a welcome relief. We should see credit growth going back up slowly but steadily as we go forward.
That's a fair point. I do want to get your opinion on the sharp reduction in the GDP growth expectation, 6.6%. Not very often that you see the central bank cut from 7.2 to 6.6%. Was that something that you had anticipated? And what are the implications for the economy as a whole? Of course, second half, we're expecting there to be more spending by the government and perhaps to a certain extent capex. Is that something that you're seeing at all take place, private capex? Any signs of that recovering?
I think if you looked at the Q2 numbers of corporates as well, I think you would clearly see that there was a palpable slowdown in the economy. And I think at this point in time, the RBI is projecting that yes, growth will go back up from the 5.4%. But our own belief is that perhaps the expectations that the RBI has put out for Q3 and Q4 is actually a tad optimistic. I think there is certainly risk to the downside on these expectations in the second half of the year, and I think this increased growth is predicated on increased, particularly increased government spending, and whether the economy has the absorptive capacity to take on this high level of government spending for capex in the second half of the year. I think is something that we will need to wait and watch. But I think there is a palpable slowdown in the economy.
And then the last question, Rajiv, that I want to ask you today is you expect, and you said this earlier, you expect that a rate cut could potentially come through early next year, February perhaps. What is your base case assumption as to how the trajectory will be in terms of the rate cuts? Of course, one would assume that this entire cycle will be shallow.
Absolutely. I think the problem that we've seen so far is, on the one side, we have certainly, like I mentioned to you, the slowdown in the economy is palpable. But on the other side, we are certainly seeing inflation being quite sticky at this point in time. We need to see those inflation numbers, come down into the four handle before we can even think about a rate cut. So I think the RBI's own expectations is that we will see a inflation number in the vicinity of about 4% sometime in February. So the earliest expectation that we have as far as the rate cut is post-Feb. But having said all that, I think the rate cut cycle itself is going to be quite shallow at the very best in this sort of an environment. We don't expect the rate cycle to be more than 50 basis points, which means that the 6.5 could at best go to 6%.
Okay, wow! Thanks so much, Rajiv, for that perspective. It reinforces certain ideas that I had as well. Thanks so much for taking the time.